Are you tired of all your profit being wrapped up in your projects, funding all the labor, all the materials, and then waiting forever to get paid? Having a loan at the very beginning of your project or a pile of cash that you could just access to use on your project till you got it to the point where it was cash flow positive, that would be awesome. My name is Scott Pieper. I'm the co-founder and CEO of Mobilization Funding. For the last 10 years, we've been helping construction businesses start projects with the money they need and execute those projects in the most efficient manner by having the money needed and available to them to purchase materials or pay for their labor at the very start of the job and before they ever get to an invoice. We're the bridge that helps them get from start of the project to the point of the project where it's cash flow positive. I'm going to talk to you a little bit about that today in this video. Let's start with the problem with traditional financing options for construction. Well, number one, there aren't any. It's super difficult to get it. Banks don't like construction industry. Banks don't like contractors. Banks don't like progress payments. Banks don't like jobs that are bonded. Banks don't like the costs. They don't like the margin. There's a million things that banks tell you they don't like, and we all know what they are. Okay, that's the first problem. The second problem is it takes forever to be able to go get a loan from a traditional banking source. There are other financing options also. Let's take factoring for construction. That's awesome. Works great for some, but a lot of times there's some obstacles there based on the fact that when factoring is worked into the equation, your customers are contacted very frequently, and there's been some negativity with factoring companies that don't understand construction getting involved in construction, and then they actually ruin it for the companies that know construction factoring. And so that puts a burden on you and limits the problems too. When it comes to bank financing, here's part of the problem. It takes a long time. You need to try to decide how much money you're going to need. They're going to put a lien on your business, typically have to be in first position, a UCC first position lien, which is totally justifiable and okay. But in doing so, you need to make sure that you have enough cash or capital in the form of this loan, and that not only can you pay for that cash, but that you can actually put it to work to help you grow. You see, if you have plans over the next 2 or 3 years to grow or double in size or triple in size, or maybe your project schedule starts off perfect and you're going to have a couple projects every quarter starting, but all of a sudden there's bad weather or a project gets delayed and you have 6 or 7 projects all starting at once. We've all been there in construction. We see that happen all the time. You might not have borrowed enough money from the bank. And now you still have you have this loan from the bank or your application for the loan from the bank, but all of a sudden you don't even have enough money that you're either eligible for or that you even asked for. It's just a hard process to help for the amount of money you need to execute on each project. To use one big loan and try to guesstimate or estimate what that's going to be over a 3 or 4 year period. Now, I'm not here to tell you don't get traditional financing because I think it's a great tool. You should get a line of credit and you should take any amount of line of credit from a bank that you're eligible for because there's other options out there for you. But having a nice line of credit from the bank that you can work off of makes perfect sense. So let me tell you how contractor financing works with mobilization funding. Basically, we work with construction companies that have projects in the form of contracts, purchase orders, master service agreements, work orders associated to master service agreements, whatever the work might be. Let's call it your revenue cycle. Whatever that project or revenue cycle is, we look at it and analyze with you what the cash flow cycle is for that specific project or that contract. What we're going to do from there is take your bid sheet, what your costs are that you've estimated, that you've won the project for, what you're going to invoice your customer and how frequently, and we're going to build out an entire cash flow model for you. That cash flow model is the same one that's on our website now that anybody can use at any time, and you may be using it currently. But what we're going to do is take that cash flow that you've estimated, and we're going to see where your costs are, when you have to incur those costs based on your supplier terms, based on when you need to purchase items, based on whether you have direct labor, contract labor, subcontract labor, or some combination of both. And we're going to see how you have to spend money in order to execute the job based on the work schedule that you've built. And then that process is going to identify a couple things. One, it's going to show us how much cash you have to invest on the project. It's going to show us when you're going to start getting money off of the project to be able to utilize to execute. And then third, it's going to show us where those cash flow gaps are. Fourth is where we can hopefully step in and help fill those cash flow gaps for you, or at least identify where the cash flow pain is Maybe it's supplier terms, maybe it's contract labor. Either one, we can help find the solutions for you by maybe just modifying what your negotiation terms are with your suppliers or your sub-labor. But if not, and you do all those things and there's still cash flow gaps there, we can become another source of cash for you to use to execute that project at the beginning of the project, before you ever invoice, and using it in a manner that helps you drive value on the project. So it's not a loan just to the business, it's a loan to the business but for that project. And then we help execute the payments to your vendors by using the money available to you right off the loan. Our project financing is used for all different types of business, but to name a few, you have concrete contractors and masons that are building huge parking garages. They're pouring giant slabs for industrial manufacturing, things like Amazon facilities. We have contractors that build out the interior of the Amazon facilities, installing the conveyor belts, putting in the footers, putting in the infrastructure of steel, not to hold up the building, but to hold the conveyor systems. We have companies that are doing just the labor portion. Some companies are providing just the material. We have directional drillers that are working all over the country, putting in the backbone of fiber for not only neighborhoods, but also whole new cities and whole different developments. We have curb and gutter folks that are putting in sewer, drains. We have site contractors building all kinds of different projects. We also have all kinds of plumbing, electrical, HVAC, mechanical, different trades doing work all over the place. These are all projects we've worked on, including government contractors that are working in disaster areas like in South Florida where hurricanes came through, or in Texas when they had a huge ice storm, or any other natural disaster that may be going on that needs work, including Hurricane Sandy a few years ago up in New Jersey area. Those are the type of projects and customers that we work with, and all kinds of others. I want to talk a little bit about some misconceptions on contractor financing, and let me go through a few with you. Well, first and foremost, we are not a factoring company. We are not buying your receivables. We're not trying to leverage your customers' creditworthiness and to give you dollars. We also don't provide money up front that you can just use for whatever you want. The money that we lend has to be used on the project, specifically for labor, material, equipment, or any other costs that are associated with that project. What's important is that our dollars are used to help you execute the project, that our dollars are also available to help you get the money you need when you need it. That's why we don't put a lump sum of dollars. If you need several $100,000 to execute a 6-month project, we all know you don't need that several $100,000 on day one. Maybe you need 20% of it on day one and 20% of it a few weeks later, et cetera, all the way over the first 60 or 70 days. And then you can pay it back as you're paid on your project. That's the key thing. Keeping our loans cash flow congruent with the way you're paid is the most important thing. We do not have monthly payments or weekly payments or daily payments. Our payments for your loan are congruent with the cash flow cycle that we've built for you at the beginning of the project and before you've ever had to decide whether or not you want to take the loan. And also, we are getting paid back as you're paid on the project. That's the key. It doesn't help if we give you a loan and then take the money out of your account for other projects or from other places if it's not going to help you become cash flow positive on the project you're trying to execute. The other misconception is that we're going to be way over involved in your business, or that we're going to be calling all your customers, that we're going to be bothering you. We are here to provide value to you. We are here to help provide you a solution to execute work. And we do that by making it great for not only you, but also for your customer and also for the project. Because the most important thing on any project is performance and execution. And if we help you perform and execute, that's going to help your project that's going to help your customer perform and execute, and it's going to overall provide the value that's needed for the whole overall project to perform. That's the key piece. In conclusion, mobilization funding is here to help you execute projects by providing a source of cash for you to use on a specific project in conjunction with the money that you get paid from the project. That source of cash that we provide to you is given to you at the beginning of the job and available to you at the beginning of the job for you to use for any project-related expenses, including labor. We get paid back as you're paid back from the project. We also only charge you for the money that you have outstanding at any given time, And we give you the money when you actually need it, not all in one lump sum at the beginning, but over the course of the cash flow that we build for you. Most importantly, yes, we are a lender, but more importantly, we provide the cash flow analysis that you need to help you make good decisions. More often than not, by us doing that cash flow, we not only can reduce the size of your loan, but oftentimes we can actually eliminate the loan. And show you that you don't even need a loan for this if you're able to go to your supplier and negotiate a little bit better term. Maybe it's extending from 30 days to 45 days. Maybe it's working with your subcontract labor to pay in 2 weeks or 3 weeks instead of 1 week or the following week. Maybe you want to keep your subcontract labor every single week, so that's great, paying them, and you can use the loan for that. And that provides great efficiencies and performance and helps your customer and helps the project. These are all things that you can do with our loan. And most important thing, we want to be able to help you execute good work, grow your business, spend the time each week on your business and in your business instead of chasing money from your customers and keep you up at night trying to figure out where you're going to get your payroll from. If this video was a help to you, please add any questions or comments right here below and subscribe to our channel. Thank you all very much, and may God bless you.